Well, I think that's all you need to know. This is a squeeze on the system. China has gone out of the market completely. I mean, you can't arbitrage silver from China to sort out our markets, and that is if they were prepared to do it anyway. The squeeze is also in China. I think it's a global squeeze, and it's the result of over 5, 6, maybe 6 years of supply shortage relative to demand, and demand is just going off the scale with photovoltaic cells and all the rest of it. So silver is it's being driven, if you like, by industrial means. There will come a point when the investment community wakes up and decides we better have some silver. I'm not going to speculate as to what their thinking might be. I think the answer to that, I mean, I've been watching, in London, we've got the largest silver mine in the world, actually, Fresnillo, listed on the London Stock Exchange. And it's been interesting to see how that performs relative to the silver price. It doesn't run ahead of the silver price. It's behind the silver price most of the time. And it maybe catches up a bit the next day. The idea that correlates quite well with the silver price, the idea that investors looking to buy or sell Fresnillo, SLB, or whatever it might be, are actually sort of bullish on silver. No, they're not. I mean, the prices are being dragged up by the physical market, not by investor interest saying, silver's the game in town, we got to go for it, we're going to buy this one, buy that. They're not doing that. They are totally absent. And the result is that the prices are being marked up or down, more or less on yesterday's performance, if you like. Basically, if you are beginning to get, the price of, let's take an index of silver stocks. If they really started to move ahead of the game, then quite clearly it would be the investment community saying, silver is in a bull market. We got to buy these mines. Yeah, they're not doing that. Honestly, they're not bullish. You and I and others, if you like, who've been following gold and silver for some considerable time, could express our views by saying we're bullish of gold, we're bullish of silver. And I've just explained why the market is short, et cetera, and that's going to drive the price higher.
While silver's fundamentals strengthen, major investment firms continue to look the other way. Most of Wall Street now focuses on AI, semiconductor giants, and high-growth tech. By contrast, silver mining is viewed as obscure, volatile, or too hard to understand. But this apathy hides a deeper problem. Major funds were never positioned for a multi-year supply crunch. Industrial demand, especially from expanding solar manufacturing, has quietly overpowered supply for nearly 6 years. Meanwhile, China's internal demand has tightened global availability even further. With arbitrage flows blocked and inventories shrinking, a worldwide squeeze is forming while institutional investors remain asleep at the wheel.
But the investment community as a whole is just not interested. They don't understand it. They would rather chase the Nvidias and the tech stocks of this world. I mean, when we start talking mines, average investor he's clueless. He's got no idea. And he doesn't want to know, really. I mean, it's just too difficult. Just give me the things I understand, he says, I think. I think that's why you've got this sort of extraordinary situation where the response from silver mines and, encapsulated in the indices, and also for gold as well, and other mines in general, is just a complete disinterest from portfolio managers. Yeah, I mean, they've had commodities educated out of them. And apart from anything else, a commodity is not a regulated investment, and therefore it's verboten. Don't go there, mate, sort of thing. Well, I think that's all you need to know. This is a squeeze on the system. China has gone out of the market completely. I mean, you can't arbitrage silver from China to sort out our markets, and that is if they were prepared to do it anyway. The squeeze is also in China. I think it's a global squeeze, and it's the result of over 5, 6, maybe 6 years of supply shortage relative to demand, and demand is just going off the scale with photovoltaic cells and all the rest of it. So silver it's being driven, if you like, by industrial means. There will come a point when the investment community wakes up and decides we better have some silver. I'm not going to speculate as to what their thinking might be.
Silver's performance is currently driven by industrial necessity, not speculative hype. The world is entering a phase where renewable energy production, electric vehicles, and high-efficiency electronics require more silver than the mining sector can deliver. Prices near $60 no longer shock analysts, and moves toward 70, 80, or even triple-digit territory are now openly discussed by commodity desks. Once mainstream funds finally recognize that silver's bull market is not a rumor, but a structural reality, capital inflows could accelerate dramatically. Historically, no financial crowd can resist a rising trend forever, and silver's moment of discovery may not be far away.
But at the end of the day, you can't resist a bull market in anything. When you see something going up, you might ignore it for a bit, but then there comes a point where you can ignore it no more, and you've got to go and buy some. We have yet to see that. And it's perfectly capable of taking silver. Well, I mean, we're approaching 60 as we are. I mean, spot is 58.3. 60 is a doddle this week, easily. I mean, that's not a forecast, but I wouldn't be surprised. 70, 80, 90, 100. I mean, this is equally possible. The other thing, of course, I'm going over to gold, which we need to move on to, is that what gold is telling us is that the whole fiat currency system is getting into deep trouble. What that means is, sorry, I interrupted you.
No, I was just going to say I have the gold chart up, but yeah, continue. Go ahead.
Yeah, I mean, the point to understand is that over long periods of time, the purchasing power of gold is stable. I mean, things change and so on and so forth, but it's been the case really going all the way back in history. I mean, the thing about gold is that the above ground stocks have tended to increase more or less in line with the global human population. I mean, we've got records that go back, quite a lot of it estimates, but sensible estimates. And we can see that relationship. And not only that, it is embodied in all our laws that it is real money, final settlement, expunging all counterparty risk. That's the important point. And it doesn't matter what the US Treasury says, whether it's a pet rock or whatever. I mean, they're just promoting their own fiat currency instead.
Gold's rise to above $4,200 is not simply a commodity rally, it is a verdict on global currencies. Across history, gold's purchasing power remains remarkably stable, expanding roughly in line with population and economic development. Fiat currencies, however, decline as governments expand debt. Today's surge in gold reflects a loss of confidence in the dollar's real value. While economists forecast easing inflation into 2026, gold signals the opposite, a coming wave of rising prices as currency debasement accelerates. Central banks quietly understand this. 2024 and 2025 saw record sovereign gold buying, confirming that gold remains the world's ultimate form of settlement.
But the fact of the matter is that in everyone's common law, gold is money, and it is a stable form of money, and has been and will continue to be through millennia. So when we see the gold price rise in 1971, from $35 to currently $4,234 as we speak, I mean, that's not gold rising, that's the dollar declining. The idea that you can measure the dollar's decline by looking at consumer price index and all the rest of it, well, that gets fiddled, as we know. The best indicator that you can possibly have, not perfect, is what is the exchange rate between dollars and gold? Now, the interesting thing, Danny, is that when you look at expectations, if you like, amongst economists and also portfolio managers, they think that inflation is becoming less of a problem in 2026. They think the purchasing power of the dollar, it might drift back towards the 2% target, but basically they don't see it going up. What gold is telling us is no, that's wrong. the purchasing power of the dollar is going to decline, which put another way means the consumer price index is going to start rising, and probably quite sharply. And we can see that. Now, the reason that the consumer price index will start rising is because the purchasing power of the dollar will be declining. We are losing confidence in credit. Now, I know many economists, most economists perhaps, think that currency isn't credit, but oh yes, it is. It appears on the central bank's balance sheet as a liability. It is credit. It is the liability of the central bank. And we know that most of these central banks, including the Fed, by the way, have obligations greater than their the assets to back them in terms of value. They just don't choose not to mark things mark to market. Basically, if the Fed was a private sector industry, the directors would be in jail now because they'd be trading well bust, effectively. We know what the situation is. We can see how the debt is racking up even further. And when that happens, bond yields rise. And as bond yields rise, what happens to equities? The equity bubble goes pop.
Yep.
And when the equity bubble goes pop, then what does the Fed, what does the US Treasury do? It rescues everything it possibly can, because that is the mandate. In other words, what we're going to see, what gold is telling us, is that the conditions that are evolving now are guaranteed to lead to the debasement of the currency, of the fiat currency, big time. So everybody's expectations that inflation is not going to be a problem in 2026 is so far wide of the mark. And I don't know of anyone who's looking at inflation in 2026 and saying, this is going to rise and rise and rise. But that is what the outcome is. That is what gold is now telling us.
Global bond markets are flashing stress signals. Japan's short-term yields, once anchored near zero, have climbed, destabilizing the yen carry trade that hedge funds have used for decades to finance U.S. treasuries. Up to $20 trillion worth of leveraged strategies may be vulnerable. Treasury demand from traditional buyers has evaporated, replaced by offshore hedge funds in places like the Cayman Islands and Luxembourg. With deficits ballooning and refinancing needs surging, the U.S. Federal Reserve quietly stepped away from quantitative tightening. The stage is set for renewed money creation, debt monetization, and intense pressure on global bond yields, fueling the next inflation wave.
The point about the Japanese bond market, and if you look at the 2-year rate, I think you'll see that's yielding more than 2% now. This is destroying the carry trade.
Got it.
I don't know if you can get it up. The 2-year JGB.
I'll search for it, but in the meantime, if you don't mind, just
Yeah. Well, basically, the carry trade is now having to unwind. It's no longer profitable.
Here it is.
Yeah, there you go. What's that yield? I can't quite see.
1.02%.
1.02. Okay, you're right. Okay, 1.02%. The problem is that if you're a hedge fund,
just really quick, up 5.4% today. Look at the distance between the previous day and today.
Capped up,
massive distance.
Capped up. Yeah, big time, isn't it? Look at that. Yeah.
Mm-hmm.
I mean, the point is that the carry trade is now a loser. And you've got what? I mean, there could be 10, 20 trillion, if you like, of funding using the carry trade to do various things, but principally finance the US Treasury. This is concerning. I mean, we've seen, for example, just about the largest holders of US Treasuries are now unknown entities in the Cayman Islands. These are offshore hedge funds, which along with Luxembourg, which basically has set up special purpose vehicles to get euros in, which yield, a lot less than US treasuries, package them up and then go and buy US treasuries. I mean, this sort of hedge fund recycling, if you like, through the carry trade is enormous. And I think the degree to which the US Treasury is depending on this to finance its deficit and to refinance maturing debt, this is leading into something which I think could rapidly escalate into a problem.
The late cycle signals are unmistakable. Bitcoin's volatility mirrors classic speculative manias, rising and falling alongside high-risk tech stocks. Margin debt in U.S. markets, now over $1.2 trillion, has inflated equity valuations to historic extremes. A significant portion of today's market capitalization is built on leverage, derivatives, and loans to hedge funds. If bond yields rise further, equity valuations will face severe compression. Like past bubbles from tulips to dot-coms, today's credit-fueled boom is fragile. When it breaks, the unwind could dwarf 1929. In this environment, gold and silver are not speculative bets. They are insurance against a global reset already in motion.
And it's no wonder that the Fed has withdrawn from quantitative tightening, because it's seen this. I think it's seen this coming. And it's going to reintroduce QE at yields.
Are they going to monetize the debt to try to bring down the interest rate?
Well, exactly. I mean, they won't I don't think they'll manage to bring down the interest rate much, but it'll take a bit of pressure off the bond markets because they've got to absorb what nobody's buying. This is the problem. So, it's monetizing the debt. I mean, that's going on, and it's going to accelerate. But where does that leave the equity bubble? I mean, this is the fascinating thing. And then, of course, we've also got, as you said, Bitcoin. Now, Bitcoin, I've been telling everybody who will listen that this is symptomatic, if you like, of the top of any credit bubble. I mean, we had, in the 17th century, we had the tulipomania. Bitcoin's like that without the bulbs. I mean, that's all it is. I mean, the idea that it's money, no way. I mean, okay, you can always get consenting adults who'll say, all right, I'll take some Bitcoin in return for this. But there's the idea that it will circulate as money in any sense is complete rubbish. It's a system which is full of crooks. Money launderers have been using Bitcoin and similar things, but principally Bitcoin, as a vehicle for money laundering for a long time. And I mean, this is something which, when it goes, it's just going to implode. And we're talking about ordinary people losing huge amounts. I mean, we're looking at huge amounts. We're talking about over $1 trillion. Bitcoin are worthless. It's just it's just an ephemeral idea. So the fact that it's now beginning to collapse, along with tech stocks looking pretty rocky, with which it has been correlating quite nicely, you can see that this is showing that the whole thing is very, very close to the equity bubble bursting, the credit bubble bursting. And look at the margin debt recorded by FINRA. I mean, that in the last 10 years has gone from 300 billion, it's currently 1.2 trillion. That's margin debt. And I mean, that's probably supporting long positions worth 3 trillion plus. I mean, that would be the sort of relationship. And that doesn't include credit, if you like, given to hedge funds and all the rest of it. There's really big guys who go direct to the banks. They don't go through brokers to borrow. They go direct to the banks. There is a lot of hot air in these equity markets, which is going to make 1929 look like a vicar's tea party.